What's going on, everybody? Happy Friday and good morning, and welcome back to Beat the Bell, presented by King Capital. Hope you guys have all been having an awesome week. The market is ripping once again this morning. Really awesome stuff to see, to talk about why. We've got an awesome panel with us this morning, starting with Mander. Mander, good morning.
Good morning. Ripping off the NFP print. We'll cover that in a second, but looking really good going into the open today.
All right, Diamond Trades, good morning.
Alejandro, what's going on? Excited to be back, and we got a little time, so let's get into it.
Diamond Trades live from the beautiful shores of New Jersey.
Man, go on New Jersey. Can't beat it, baby.
All right, Stock Snipa, good morning.
Good morning. We got an awesome segment on Bet the Bell. I know they say that every time, but it's actually extra awesome today.
All right, let's do Fed forecast and economic calendar.
Yeah, so instead of the economic calendar today, let's just cover the NFP. The NFP print just came out a few minutes ago, so the NFP came in at 187,000 versus the previous of 185,000 and 180 expected. So more or less in line with what the market was expecting. We got that initial pop there on the print. The unemployment rate came in at 3.8% versus 3.5% previous and 3.5% expected. So a little bit hotter than anticipated on the unemployment rate there. Which is actually, depending how you want to look at it, might be actually a good thing, seeing that some of the pressures in the labor market are easing. That may help put some downward pressure on prices. We'll have to look at that going forward. The one thing that I know a lot of folks are looking at coming into this data release was the average hourly earnings, how that's going to be important and play a factor in the Fed's decision-making going forward. Average hourly earnings month over month came in at 0.2% versus 0.4% forecasted. So that lower than expected average hourly earnings growth, again, may put a little bit of downward pressure and help to ease some of the labor market tightness that we've seen over the last several months and so far this year. Let's go ahead and cover this week's trading. So the market has rallied aggressively to close August here over the last 3 or 4 days, recovering much of the losses that the market sustained in the early part of the month. Even given the rally, all three indices did close the month red. So the Nasdaq fell 1.13% in August, and the S&P fell 1.3% in August, the first red month for either index since February. The Dow fell more sharply, losing 2.1% this month, or last month in August, the first red month since May. Yesterday's trading was mixed to close out the month, with indices losing steam after 3 days of aggressive buying. The pullback doesn't necessarily mean that the trend has stopped. However, though we're trading into a seasonally difficult period for markets, that September time period, as we've covered, ad nauseum at this point, tends to be a choppier to down month for the markets. The indices were able to, flip previous highs into support, which is, a good thing, and reclaim their 50-day simple moving averages. So we'll have to see if the market can buck its recent trend of a weak September and find a push higher into the start of fall. So the push actually may come from a bit of good news that we got yesterday. So depending, it's good news depending on who you ask regarding consumer spending. So yesterday, the Department of Commerce announced that consumers increased spending in the month of July at a rapid pace, a sign that the U.S. economy remains resilient in the face of elevated interest rates. Households rose spending by 0.8% in July, higher than the 0.6% pace in June, with many consumers spending more on groceries, recreational goods, and vehicles, and on services such as housing, dining out, and insurance. The Fed's preferred gauge of consumer prices, the Personal Consumption Expenditures Price Index, or PCE, rose 0.2% in July from a month earlier, the same pace as in June. Core PCE, which excludes the volatile food and energy sectors, rose at the same pace month over month, and a 2.9% annualized rate, which is the lowest reading since 2021, and closing in on that Fed's 2% target. So according to Atlanta Fed President Bostic, the data actually supports an extended pause in rate hikes, exactly what the market has been expecting for several weeks now. So it's good to see that the data that we're getting to come out has sort of been confirming the market's bias that the Fed is going to pause the next meeting and likely keep rates elevated going forward here. So I guess no real change in expectations, might be good news for the market. Sal, what do you think?
Yeah, so to your point, looking at Fed countdown here, this forecasting tool, we're now at a 91% probability of a pause. And I think kind of looking at the data, this really supports what the Fed is looking for. And so I'm not surprised by the pop here, even though unemployment is up by a little bit. If you kind of sift through the actual numbers and compare everything to each other, wage inflation is coming down. Non-farm payrolls still came in above consensus and expectations, and jolts came down with unemployment rate going up. And so what that says to me, with non-farm payroll still being above consensus, is that unemployment rate could just be going up because people are re-entering the workforce and just not quite finding jobs yet. But at the same time, jolts is coming down, so jobs are getting filled and or taken off the board. Wage inflation is coming down. And if you looked into that jolts report yesterday, job quits were actually down to pretty much pre-pandemic levels. And so people aren't quitting their jobs. Jobs are getting filled and or taken off the board. And so this unemployment rate going up a little bit, to me, just seems like people are now re-entering the workforce and qualifying themselves as open to labor again, people that may have retired in the post-pandemic bubble we saw there. And so I think all of that is good. That's what the Fed is really looking for here. So I'm not surprised by the pop we're seeing, and I'm really not surprised by the move in treasuries we're seeing that's now pricing in a 91% chance of a pause. The big thing is the pause is expected to be going on until May now. So that's that higher for longer narrative we've been seeing. And that's what I wanted to cover as we move into September, which is historically one of the worst months for the stock market moving forward. Is I wanted to cover exterior risks that could pose a threat to the stocks as we're almost trading pretty much back at near all-time highs. I found a chart here to cover the U.S. Treasuries, namely the 10-year. And what's different now, because that's really become the talk of town, what's different now versus when they were at these levels back in October? And really what that is inflation. So the 10-year tips here is what we're looking at right now. That's the Treasury protected, the inflation protected Treasury here. So this is basically netting out inflation. What is this yielding? That is now pretty much back to 15-year highs as well as the normal 10-year. Whereas if you go back to October, you can see that was pretty much at 25-year lows because inflation was at 7.7% with a negative real yield. And so while this didn't really pose a threat to stocks back then, because while there was risk of inflation to stocks and profits and the whole recession talks, no one was going to get out of their stocks that were still up from before the COVID drop. No one's going to exit those while still in the green to then go lock in a negative 2% real yield on a treasury. But now at a positive 2% real yield with inflation coming down, that is definitely all else going to be equal. No news, no catalyst, everything else equal. That is definitely going to pressure the stock market. And especially if we're going to see a higher for longer narrative with inflation still coming down, this could push up to like a 2.5% yield on the 10-year tips here. That's definitely going to start looking appetizing to some people, especially with the current multiples that some of these names are trading at. So broadly speaking, the resilience in the economy, it kind of brings like two conflicting things here, with revenues and profits mostly beating to the upside here. That's really fueled this historic rally we've seen, but also that is then going to fuel inflationary pressures and the higher for longer narrative. That's obviously we've seen the repricing in treasuries, especially on the longer duration of the curve on the 10-year and the 30. So you kind of have a double-edged sword here. And right now, if we pull up the second chart here, Ryan, you can see that stocks and yields have gone back to their fundamental inverse relationship, which really we didn't have for the most part of 2000 and the 2010s, because people were more appetized by the profits and revenues aspect of the double-edged sword than they were fearful of inflation. Right now, as we turn back to the fundamental negative correlation, that is showing investors are more so inflationary pressure fearful than they are hungry to get into the potential profits of the stock market. So that's the one thing. I'm still in the bullish camp. I think, as Noah said, we saw support. We saw previous resistance flip as support in most of the indices. Really just looks like a textbook pullback. But as we move into what has historically been a rather bearish month, I would definitely keep an eye on the 10-year and 30-year, namely, and see how treasuries are going to react. If we start to see another push in yields, it's definitely not going to be good for namely tech and the Russell 2000. A lot of those names that have gotten a pretty significant bounce here off that pullback.
Right. I mean, I agree. I think that that's probably like the primary risk to stocks going into the fall here, outside of like some sort of like looming credit event. I would definitely believe, and obviously if we were to get some sort of credit event, you would see yields rise. I think that's probably the largest headwind that we have to pay attention to stocks going into September here, just to see if the past is sort of any if the past is any prediction on what we're going to get going forward. September, historically a terrible month for stocks. That is ideally where you would want to see that correlation, right? Is if you see yields start to push. For me, I think that would make me start to think, okay, maybe this is not just your textbook flip previous resistance into support and continue rallying. Maybe this is something a little bit deeper. But that's going to wrap it up for us here for the forecast. Pass it back to Alejandro.
All right, awesome stuff, gentlemen. Thank you. Let's take a look at the S&P quickly before we go over to Bet the Bell with Stock Snipa. So let's take a look at the system. We haven't looked at the system and a few shows. So we're due here. And of course, we've gotten the buy signal, as you guys know. And what that is just the bullish cross of the 10 SMA over the 50 SMA. So we did go through that period of chop and selling to start the month of August. And we understood that trading below the 50 SMA, especially on the 1 hour chart, was bearish for the S&P. And so we saw a lot of the pops getting shorted and really no momentum that was able to be gathered by the bulls. Okay. So finally, we get the break over the 50 SMA, and now we're resuming an uptrend. More importantly, what we're doing today, if you take your S&P 500 chart, you draw a channel from the March lows through May, you'll see that we were trending in a super strong uptrend for the majority of this year. And today we're trying to now reclaim that uptrend and get back into that channel. So bulls have obviously a lot working for them as long as we're trading above the 50 SMA on the 30-minute and 1 hour charts. So again, the system not necessarily providing you a trading signal. Obviously, the time to get long would not have been right now, as we've rallied, 150 points off the lows. But getting long on the buy signal is, of course, a really solid entry, but also just plotting your levels of support and resistance and understanding those high risk versus reward areas where you can add to your longs, then taking a look at the system and seeing that, yes, it is in fact aligning with your thesis and that momentum is on your side if going long when you're trading above the 50 SMA on both the 1 hour and 30-minute charts. All right, that's going to do it for the system. We're going to pass it over to Snipa for Bet the Bell now.
Good morning, guys. Let's start this off by taking a look at the standings as we typically do. It's pretty close between Diamond and Hondo at the top. We can see they're both tied at 56 wins. Hondo just has one additional loss. We can see 65 to 64%, really close. They've been going neck and neck. Interested to see how today goes and how it goes going forward. But I'm going to go ahead and start this off with our first question as typical, green or red? And I'm going to start this one off with Diamond.
I'm going to go red today. I don't love the pick, but given the week that we've had, maybe like a little pullback into the weekly range would be ideal. So I'm going to go red.
Hondo, what do you got? Or Mander, I'm sorry, Mander.
Mander. Just off the pre-market strength here in tech, I'm going to take green on the day.
I like it. Hondo, what do you got?
I'm going green.
Yeah, I think I'm going to have to go with green as well. We have seen a little flip. But if I'm a betting man, I'm going to have to go with green. I'm going to go ahead towards the next question, which I find this pretty interesting question, especially for those of you who are learning to trade and some that might be new traders. But what has been the hardest lesson in your trading journey, you could say, in the entire time? I'm going to go ahead and start this off with Hondo because I'm sure he has something pretty good to say here.
Is that me in the little picture? It looks like me
Sorry?
right now. That looks like me in the little picture at the bottom of the screen.
I think that is you.
The most important, there's a lot of important lessons. I'll just talk about one. And we did a podcast yesterday, Noah and I, where we talked about some of this. That'll be coming out this weekend. An important lesson that I've had to learn is that drawdowns and red days are part of the process, of course. And using that frustration and anger and all that emotion that you feel, it's very, very difficult to eliminate that. But I've learned to channel that into doing the right thing versus having like emotional blow-ups. And the sooner you realize that at no point does this ever become easy, like you're always going to have those red days, you're always going to have those drawdowns, the sooner that you'll be able to get yourself in a more proper mindset versus getting pissed off and blowing up your account every time that you have those drawdowns. Recognize that if you're doing this for, you could be doing this for a year, you could be doing it for 10 years, you're going to have those drawdowns. So you better learn to deal with it fast. And stop letting it impact your trading so much.
I like that. Really good answer there. I'm going to go ahead and tune over to Money Mander next.
I think Honda makes a great point in that the stock market's binary and it's zero sum. So like when you lose a trade, it's easy to get pissed off at the stock market and this, that, and the other, and then trade on tilt. But really, you're the only one at fault. And then if you go ahead and let that take into another bad trade and lose more, that's really, I think, the journey that a lot of traders get to at the start, which is like the biggest thing to avoid. But mine has probably been getting comfortable and content with taking gains, especially in options trading. When I was new to the game, like you're up 100%, 200% in a trade, you think you're killing it and you just want to hold these until they go 10x, right? It's so easy to let gains come back, especially in options trading, because stocks go up, stocks come down. But a pullback in the stock, even if you're right on direction, is going to destroy you with theta decay. So I think the biggest thing that I see a lot of new traders needing to overcome is just that greed aspect and being happy taking gains when they're there.
I like that. See profit, take profit. Diamond, what do you got for us?
I'm going to use a spoiler alert from the podcast that we did yesterday. But if you guys have ever seen Kung Fu Panda at the at the end of great movie, by the way, at the end of Kung Fu Panda, the antagonist winds up he's going after this scroll the entire movie, and then he finally gets it at the end, and he opens it to find the secret to what does it mean to be the dragon warrior, and it's blank, right? It's just a reflective scroll that shows him a picture of himself. And the protagonist, Poe, says, you know what? That's the secret. The secret is you. The secret has always been you. The secret is inside of you. And I think that applies to so much in life, but that definitely applies to trading in the sense that you can spend your days studying your ass off, watching a million YouTube videos, hopping from strategy to strategy, trying to find the holy grail. Ultimately, none of that matters. It really does come down to you. You are the secret ingredient. It is really you versus you in the markets. And ultimately, if you can't conquer your own mind and your own emotions, no strategy, no amount of studying, no amount of hard work is going to make you a profitable trader in this market. You really do have to conquer yourself to ultimately be successful at this game and be successful at life. And so that's probably the biggest lesson.
I like that. Diamond trades with the Kung Fu Panda reference, for the record. I'm going to honestly say what my hardest lesson is, and, I'm also kind of going more towards biggest trap, but I know everybody or almost everybody watching this has definitely seen a tweet somewhere that says $1 turns into $2, $2 turns into $4, $4 turns into 8 to 16, etc. That's bullshit. It doesn't work like that. You're not going to have 2,000.
I need the doubles every day.
Yeah, that's
doubles every day.
That honestly, when I started trading, kind of made me think, okay, I could just double my money every single day. A long time ago, but I want to go ahead and say that that's bullshit. And I know I've said that like 4 or 5 times now, but forget about all of that. That's definitely one of the hardest lessons or biggest traps that I would say inside of trading. I'm going to go ahead and transfer over towards my next and final question for Bet the Bell today. But this is tying into a bit of Teslanomics, I think, whatever. The question is, we can see here in the tweet, Tesla has dropped the prices of the Model S and the Model X by 20%, which is pretty significant. My question for you guys is, why has Tesla done this? Is this to make it more affordable? Is this to push more volume? What do you guys think the reasoning behind this is? I'm going to go ahead and start this off with Diamond Trades.
I think that's kind of been their game plan over the past several months, if I'm not mistaken, has really been to instead of focusing on margins and profits, I think that they're trying to gain market share, at least retain market share in the EV space as a lot of other entrants and competitors come into the space. Their plan has really been to retain their market share by lowering the price of their vehicles, which is having a negative impact on their margins, obviously, and they talked about that in the last earnings call. I think that if you're a long-term believer in the company and in the stock and the vision of Elon, then this is not necessarily the worst thing in the world. I understand that, like I said, that it obviously has a negative impact on the margins, but I think that over the long term, if they're able to retain market share in the space that is expected to grow so much over the next 5-10 years, you want them to be able to have that volume, and then ultimately later down the road, maybe when the economic backdrop looks a little bit clearer, they can go ahead and start to raise prices again, and really capitalize on that market share that they were able to retain. So, yeah, I think that it's really part of their strategy, their express strategy, over the past several months here.
Very sophisticated answer there by Diamond Trades coming from Jersey Shore. I'm going to go ahead and go over to Hondo next, and let's hear what he has to say. Why has Tesla lowered their prices?
So I'm in agreement with Diamond. I think that this has been their strategy for a long time, trying to get people in Teslas. We talked about it earlier in the year when they were first doing the price cuts. And I think it's a really aggressive play, and it puts other car companies, specifically EV companies, in a position where they're going to be lagging behind as far as market share is concerned, as as more people jump in Teslas. So as an investor, this is something that I really like to see, quite honestly. And I know that they got burnt a little bit on margins last quarter. We saw that evidenced by the earnings report. But I mean, that's a short-term effect for what I think will be, a long-term positive impact as they gain market share, like I said.
I like that. Money Mander.
This is a great segue. Whoa, green screen's acting funky. This is a great segue from my segment on Monday that just got absolutely chalked with my microphone. What I was trying to talk about was they just released their new FSD V12, which I also think I saw was on like a $3,000 sale for new cars. It's like down to 12 grand. I've come to eat my words on like Tesla trading at the multiple it does versus every other car company that I've come on the show here and said it doesn't like deserve this. I think Tesla should best be looked as a data company more so than just the margins they make on cars. And that's really the push here, is to get people in Teslas, but it's mostly so they can get more data through these cameras as they're trying to go into a fully AI system with their self-driving. So the more miles, the more hours they can get utilizing the camera system on the Tesla to really push for that full self-driving really then goes into them with the semi truck. They want to have autonomous taxis going through the US. So I think all of that down the pipeline is all based on right now getting as many hours of Tesla FSD beta driven as possible. And so if that takes 20% price cuts to get there, I think that's what they're shooting for.
I like that. I honestly don't even want to go after that answer. Yeah, I think that honestly, I want to kind of chime in on a little bit of things that everybody said. Tesla did miss a little bit on their margins quarter three. I know that they probably want to blow it out of the park quarter four. Yeah, I'm going to have to just go ahead and stick with that, to be honest, after Money Mander's answer. But that'll wrap it up for Bet the Bell today. Passing it back to Hondo here.
All right, guys, that's going to do it for this morning show. It's going to do it for this week. Everybody enjoy their long weekend. Market is closed on – stock markets at least are closed on Monday. Futures market open half a day. So we will not be live. We'll see you guys back here on Wednesday morning at 8:30 a.m. Eastern. We'll be trading live all day today in the King Capital Discord. You guys can go to king-capital.com or scan the QR code on the screen. Once again, enjoy your weekends, everybody. Be safe, be smart, and we'll see you next week. Have a good one.